Stop waiting for rates to come down. Now, this might not be a popular opinion with all the agents and other loan officers talking about rates coming down this year. First off, let's get this straight. The Federal Reserve, aka the Fed, doesn't directly control mortgage rates. They simply control the interest rate that banks charge each other for overnight lending. But more importantly, mortgage bonds, treasury bonds, and even stock prices are based upon future expectations, based upon the consensus of the investors that buy them. So when the future expectation is that the Fed is going to reduce the federal funds rate, this is already priced into mortgage rates. So the rates that you're seeing today are based upon that information. Mortgage rates, and specifically treasury bonds, are more sensitive to the rate of inflation and whether or not we have an impending recession or a booming economy. And just as we saw recently, mortgage rates did not take kindly to the recent CPI report that came in higher than expected. Now, the Fed was expected to lower rates in March, which they're not going to do. And if inflation keeps up, there's a good chance the Fed may reevaluate how many rate cuts they expect to do this year. So instead of being consumed with what rates are doing that you have no control over, advise your clients that the payment is what really matters. And here's something you should really be concerned about. For every 1% drop in rate, there's 5 million more eligible buyers. So if you happen to be in a position where you can afford to buy now is not the time to be waiting when your competition is forced to stay on the sidelines.